You know, we're always hearing it, right? Always be buying. Time in the market beats timing the market. And look, most of the time, that's solid advice. But what if this time is different? What if investing on autopilot right now, maybe driven by a little bit of FOMO, is actually a huge mistake because the financial rules have quietly changed? And that brings us to the big question, doesn't it? Is right now really a good time to invest your next dollar? All the conventional wisdom out there is screaming yes. But let's pause for a second and take a closer look, because the standard answer, it might not be the right one for you, especially in the world we're living in today. In fact, I'm just going to say it. For a lot of people, maybe even you, investing right now is a terrible move. Putting more money into the market without a solid foundation could literally be one of the worst financial decisions you make all year. It's kind of like building a house, but on a foundation made of sand. So I'm asking you to do one simple thing with me. Just press pause, just for a couple of minutes. Before you even think about investing another dollar, we're going to run a quick financial health check. We're going to make sure you're not falling into 3 really common and really dangerous traps. Trust me, this short pause might just be the most profitable 5 minutes of your year. Okay, first up is what I call gate number 1, the debt anchor. I want you to imagine trying to swim a race, but you've got a heavy anchor tied to your leg. That's exactly what it feels like to invest while you're carrying high-interest debt. You're kicking, you're paddling, you're working so hard, but this invisible force is just constantly pulling you down, making it almost impossible to actually get ahead. Somebody once put it perfectly, and I love this metaphor. Trying to invest while you're in high-interest debt, it's like trying to run up a down escalator. You're putting in all the effort, right? Your feet are moving, you're getting tired, but you're not making any real progress. You might even be losing ground without realizing it. Let's just look at the brutal math here. Let's say you have an amazing year in the market. You get a 10% return. That's fantastic. But if your credit card is over here charging you 22% interest, you're still losing. Your debt is growing more than twice as fast as your investments. The market gain is a hope. That debt is a guaranteed reality. So this brings us to our very first rule, and it's simple. The 7% rule. If you have any consumer debt, credit cards, personal loans, whatever, with an interest rate higher than 7%, just stop investing and pay it off. Think about it. Paying off a 22% credit card isn't just paying off debt. It's like getting a guaranteed risk-free 22% return on your money. You are never going to find a better deal than that in the stock market. Okay, so let's say you've conquered your debt. You're ready to go, right? Time to invest. Well, not quite. First, we need to build your emergency shield. This is what's going to protect all your hard-earned investments from the crazy, unexpected curveballs that life loves to throw at us. Because let's face it, Murphy's Law is a very real thing, especially with money. The car will break down. The roof will leak. A surprise medical bill will show up in the mail. If every single dollar you have is tied up in the market, what's your plan when one of these things happens? Well, for most people, the answer is you're forced to sell your investments. And here's the real kicker. Life's emergencies, they have this nasty habit of showing up right when the market is down. So you end up being forced to sell at the absolute worst possible time, turning what was just a temporary dip on paper into a permanent, real-life financial loss. So, how do you build this shield? It's really just a simple 3-step process. First, figure out what 3 to 6 months of your absolute essential living expenses looks like. Second, open a separate high-yield savings account. This is key. Keep it separate. And finally, just automate your contributions. Set it and forget it until you hit your goal. It really is that simple. And this brings us to the buffer rule. Your emergency fund is the shield that stands between your portfolio and real life. Without that shield, your investment portfolio becomes your emergency fund. And that, my friends, is a recipe for disaster. All right. You are debt-free. Your shield is built. Now we can finally talk about putting money into the market. But first, we have to pass gate number 3, the Rearview bias. This is the incredibly dangerous trap of making all your investment decisions by only looking in the rearview mirror, basing your whole strategy on what worked yesterday. And the danger here is pretty obvious, right? For the last decade or so, you pretty much could have just thrown money at a handful of big tech stocks and done incredibly well. But when the economic tide turns, when things like interest rates change, the most popular, most crowded trades are usually the ones that get hit the absolute hardest. Let's just look at the data for a sec. A company's PE ratio is just a fancy way of saying how expensive it is compared to its profits. A high number means you're paying a lot for it. And as you can see, the PE ratios for a lot of those popular tech stocks today are way higher than their historical averages. That just means they're pricey, which leaves them less room to grow and, frankly, a lot more room to fall. So, I want you to take an honest look at your own portfolio. Does it look something like this? Is it super concentrated in just a few of the big winners from the last decade? If it is, you're not diversified. You're actually making a really concentrated bet that the past is just going to repeat itself, and that is a very risky bet to make. Now, this is what a more balanced, all-weather portfolio might look like. See, it's not about ditching last year's winners. It's about balancing them with other things. International stocks for global growth, smaller companies for that higher potential, and things like bonds for stability when the stock market gets all rocky. This diversification, it's your best defense against whatever the market throws at you next. Okay, we've made it through the 3 gates: debt, emergencies, and market psychology. Now it is time for the final verdict with our green light checklist. Are you actually ready to invest? Let's find out. Here it is, the checklist. Number 1, the debt test. Are you totally free of any high-interest consumer debt? Number 2, the sleep test. Do you have that 3 to 6 month cash cushion so you can sleep at night? And number 3, the plan test. Do you have a real diversified investment plan, or are you just chasing hype? Look, if you checked all 3 of those boxes, then congratulations. Seriously, you are ready to invest with confidence. But if you missed a box or 2, that's okay. It just means your next step is crystal clear. Pause investing and focus on strengthening that foundation. It might feel like boring work now, but your future self will absolutely thank you for it. And that leaves you with one final and really crucial decision. When that next dollar comes in, what is its highest and best use? Is it for chasing growth in the market, or is it for building the solid foundation that's going to support that growth for decades to come? The choice is yours. Make it a good one.